Welcome to Simplify My Numbers, the show for the 765 entrepreneur. Seven-figure revenue, six-figure take-home income, and five figures lost to taxes every year. If that sounds like you, you're in the right place. My name is Fabrice Matan. Each episode, we break down real tax planning strategies that help seven-figure business owners legally reduce taxes and keep more of what they earn. Let's stop guessing and start planning your taxes on purpose. Let the show begin. 7, 6, 5, 4, 3, 2, 1. The Simplify My Numbers podcast is for informational and educational purposes only. All right, so in this episode, we'll try to do something a little different. I'm inviting my producer to kind of ask me some questions about different tax strategies I like to use for our seven-figure business owners. And we'll try to, see how they rank. Yeah, Brian, how about you give a little context about what we're doing here?
Yeah, so we're going to play a little game.
Okay.
And what I'm going to do is I'm going to give you two items that would be considered a tax strategy.
Okay.
And you're going to tell me which one you would choose for the seven-figure business owner. Now, before we get into it,
specifically seven-figure,
what would you say is like this seven-figure business owner who would maybe we're talking about here?
For sure.
When we talk about the 765 entrepreneur.
Right. So the seven-figure entrepreneur is typically the business owner running a company that grosses seven figures annually. And I say gross because it's top-line revenue. So $1 million or more in top-line revenue. Typically, they land between 0 to 500,000 in net profit for themselves. So they become a six-figure earner, and then they typically see about five figures in taxes on that income. That is the 765 scenario that we typically talk about.
Okay. So with that in mind, I'm going to run through these, and I'm going to give you those two tax strategies. You tell me which one you'll choose. So First, S-Corp election or accountable plan.
The accountable plan is great because that is essentially reimbursing you for business use of your personal assets, but it's still limited to what you're already spending, right? So I would say S-Corp election on that.
S-Corp election or hiring your children in the business.
So hiring your children is a great strategy as well. As long as you're paying them under the standard deduction, you get an opportunity to take that deduction without your children seeing any tax event on their end, right? The problem is that it's still limited to standard deduction to make sense and the number of kids that you have. So I'm going to say S-Corp election.
Okay. S-Corp election or Augusta Rule.
Oh, okay. It's getting fun. So the Augusta Rule is still limited to 14 days, right, of you being able to rent your home to your business. And it's limited by market rate because you can't just determine whatever rate you want that to be. So I would still go S-Corp election because I believe with the S-Corp conversion, you can sometimes save between $10,000 to $50,000 in taxes just by doing that.
Okay. S-Corp election or cash balance pension plan.
Ooh, okay. Now we're getting, this is the big boys, right? Cash balance pension plan, I believe, allows you to put so much money away that it could create an extremely high tax deduction for you. So I'm going to go cash balance plan on that one.
Cash balance pension plan or solo 401k plan.
Okay. So the solo 401k, that would only work if you are by yourself in the business, maybe just yourself and your spouse, but it's still limited, right? There's some federal limitations to how much you can invest in that solo 401k. So I'm going to go with the cash balance plan again.
Cash balance plan or cost segregation on long-term rental property.
Okay, so specifically on long-term rental properties, cost segregation. I'm going to say the cost segregation is more powerful, but it might be limited somewhere there, right? Because it all depends on what your status really is. So we might need some extra strategies to go along with that, but I'm going to go cost segregation on long-term properties.
Okay, so then the cost segregation on long-term rental property or real estate professional status.
Okay, so now we're talking. If you're a real estate professional, then you can unlock all of the real estate losses that you have to offset your ordinary income. So we can't just do the cost segregation by itself and just call it a day. We want you to be a real estate professional, right? So RPS is what we call it, real estate professional status, so that you can take advantage of the depreciation at the highest level. So I'm going to go real estate professional status.
Okay. Real estate professional status or short-term rental strategy.
That's a tough one. I'm going to say short-term rental strategy. I think it's harder for you to be a real estate professional than to simply do what you're supposed to do for your rental to turn into a short-term so that you can take advantage of the tax deductions there. Because to be a real estate professional, you would still need 750 hours spent on real estate, and you cannot spend more time on anything else, right? You have to spend more time in real estate activities than anything else that you do. Short-term rental, you could still have a full-time business or even a full-time job, but as long as your average rental stay is less than 7 days and that you spend more time than anybody else on your Airbnb or VRBO property, then you can turn that into a short-term and then do a cost segregation, take depreciation, and offset all of your ordinary income. I'm going to go short-term rental.
Short-term rental strategy or Section 179 vehicle deduction.
Okay. Short-term rental again, because the vehicle deduction is still limited to the vehicle and the cost of the vehicle. I would argue that your rental could cost anything, right? I mean, it could be any amount, right? Your vehicle can only cost so much and you can only need so many vehicles, right? So I'm going to go short-term rental.
Short-term rental strategy or R&D tax credit.
The R&D tax credit is great, especially in this day and age where so many companies are trying to figure out how to implement AI and create something new. And a lot of them are kind of losing a lot of money doing that. I've been doing a lot of strategy sessions regarding how they can use R&D tax credits to, offset some of those losses. But here again, I'm going to go short-term rental because R&D tax credit does not apply to every business.
Okay, then finally, short-term rentals or buying equipment using bonus depreciation.
Oof. Okay, so depending on your business, right? A construction business that actually owns its own equipment can definitely see a lot of a high deduction from bonus depreciation by buying a bunch of equipment if they need it in their business. But it's still limited to the amount of equipment you need, to the cost of that equipment, and to the type of business you really run. So as an accountant, I won't be able to justify that kind of strategy, but I can justify the short-term rental. So I'm going to go short-term rental as my number one.
Okay, that sounds great. That's all I got for you today.
Okay.
Take us home.
Yeah, so I mean, essentially, what I don't want you to take from this episode is that the short-term rental strategy is the number one tax strategy for everybody, right? It all depends on your situation to see if it actually makes sense, which is why tax planning is so important and actually having a tax strategies that you can do this with throughout the year, right? So all I was doing essentially was just kind of looking at what a 765 entrepreneur typically faces in terms of tax liability and tax exposure, and then figuring out what do I like most. It doesn't mean that we can't take advantage of all of those strategies together. We can still combine several of them. But if you ask me to pick one, I'm giving you the one that I think applies in most cases and the one that essentially creates the most tax savings. So thanks again for listening to us today, and I can't wait to see you on the next episode.
Thanks for listening to Simplify My Numbers. If you found value in today's episode, there are 3 things you can do to support the show. 1, subscribe so you never miss a strategy to protect your profits. 2, leave a review on Apple or Spotify. It helps us reach more founders just like you. And 3, share this episode with one fellow member of the 765 community, someone you know who's working hard but losing too much to tax inefficiency. Remember, your chaos is our comfort zone. We'll see you next time.
This show is part of the ICT Podcast Network. For more information, visit ictpod.net.